Would you like to learn the property investment secrets of Australia's richest property investor? Well, today we're going to be exploring the powerful strategies that fueled Harry Triguboff's ascent to billionaire status as we learn 7 lessons from the $26 billion man who regularly ranks as number 1 or 2 in Australia's wealthy person list. My guest today is Tyron Hyde, Director of Washington Brown, who saved Harry Triguboff billions of dollars over the last 20 years. So I'm keen to hear the lessons he's learned, working closely with the most successful property investor in Australia, and I hope you're going to get some hints on how to become more successful yourself. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
My guest today is Tyron Hyde, Director of Washington Brown. Now, he began his journey as a cadet at an international quantity surveying firm, and now he owns it. Tyron's client list includes major developers like Lendlease, Walker Corporation and Meriton. But one of his big claims to fame is saving Australia's richest man, Harry Triguboff, billions of dollars over the last 27 years. So today I'd like to ask him what he's learned from working with the $26 billion man. Welcome, Tyron.
Thank you so much for having me on, Michael. I appreciate it.
Well, in the property arena, you've been there for a long time, and clearly you rub shoulders with some very successful property investors and developers. But before we hear the lessons you've learned from them, maybe you could tell us a little bit about you and why we should even listen to you.
Sure. So I own a company called Washington Brown. We've been around for 45 years. We're a quantity surveying company, and we specialise in depreciation schedules now. Now, quantity surveyors, we work out what things cost to build. But I didn't always want to be a quantity surveyor, Michael. I actually wanted to be an accountant. And in 1988, when I finished my HSC, I didn't get the marks to get in. So someone suggested to me, why don't you do this thing called quantity surveying at UTS? And I looked it up. It was a combination of maths and construction. And I love both, Michael, so it kind of worked out perfectly. So I enrolled at uni for 2 years, and then I did what all good young Aussies should do, and I backpacked around the world for 3 years.
Oh, really?
Yeah. And the number one thing I learned from that, Michael, was that I never wanted to work for minimum wage again. So I came back and I finished my degree. And in the final year of that degree, I wrote a thesis on property depreciation, which is what kind of is where Washington Brown is at now. But in that final year of uni, because I was like 24 at that time, I thought to myself, I'm too old to get into the industry. And I came to uni. On the boards or the columns at uni that day were all these job ads. Cadet wanted, Washington Brown. And I went and stole them all, Michael. So I was the only one to turn up for the interview. And I got the job. And then what happened was in 1997, the laws changed. And the government said, if you don't know the construction cost of a property, we'll accept an estimate from a quantity surveyor. And I'm like, whoa, I've just written a thesis on this. So I went out on my own. I left Washington Brown and I started my own company. And then my boss, and that went quite well. Then my boss at the time, or my previous boss, said, why don't you come back, join as partners, become 50-50? And my side, so we did. And so my side took off, and then I ended up buying him out. And that's how I ended up with a 45-year-old company, even though I'm 53 years old.
Ah.
That's the background.
Well, you've also got some big clients. How did you get to know Harry Triguboff?
Well, because what happened was, so I actually kind of started the industry. There was 2 companies only doing depreciation back then. Me and another firm called Napier and Blakely. And because I knew about this topic, and no developer really did, he saw what I was doing, and they used to do it themselves, Meriton. And he invited me in and said, look, can you help? Oh, well, of course I can help. And that was the start of our relationship. Now, for those of you who don't know who Harry Triguboff is,
yep,
he's worth $26 billion. He's been ranked consistently the wealthiest person in Australia. I think he's number 2 now behind Gina Reinhart. But, she's getting sued by her children. So don't know where that's going to end up, Michael. That must be a frosty Christmas lunch. To put his wealth in perspective, if you were to merge Suncorp Bank, which owns AAMI, GIO, Vero, together with the AMP Bank, you still haven't reached his personal net wealth.
Wow.
Right? And Oxfam last 4 years, they estimate that he made $1.5 million per hour over the last 4 years. So when he invites me for a 2-hour lunch, Michael, I'm scared for the next fortnight. He's going to send me an invoice for his time.
Yeah. But obviously it's worth his while having a chat with you. You've helped him. So you've spent time with him. You've worked with him for a long time. Have you managed to distill some lessons that you could share with us?
I just recently gave a talk in Cebu called The 7 Lessons from the $26 Billion Man. I might break down those lessons if that's okay.
Yeah, that'd be great. Thank you.
Okay. Well, the first is I was reading a book called Atomic Habits. I don't know if you've read this book.
Yes, James Clear.
Fantastic book. And for those of you who haven't read it, and I was reading this book and I thought, my God, Harry is the ultimate 1% man. And for those of you that haven't read it, the book, I break it down to 2 parts. It's about creating good habits for yourself and how to keep those habits as well. And I'll give you an example. One might be to delete Instagram and Facebook off your phone and just use them on your desktop, right? And I did it, you get 2 hours extra a day in your life back, right? Another habit might be, if you want to go training in the morning, leave your gym gear at the front door. You're more likely to get up and go training rather than getting up at 6 o'clock and rummaging around trying not to wake your partner up. So that's one part of the book. The other part is the 1%ers that you can change in your life that will have a compounding effect on the success of what you do, whether it be business or physical, etc. And they give an example of this guy named Dave Brailsford, his name was, and he was a British cycling coach. And before he got involved in the British cycling team, they had done nothing for 100 years. They hadn't won a Tour de France for 100 years. He gets involved, they end up winning 6 Tour de France's. And it's credited that he changed the 1%ers in that British cycling team. He got doctors in to teach them how to wash their hands so they wouldn't get sick. He changed their pillows so they wouldn't get sore necks, etc. And that's credited of having this compounding effect on the success of that team. And I'm reading this, I'm thinking, my God, this is Harry to a nutshell. So I'll tell you a story, Michael. So I just read a book called Claim It. And Harry invites me to lunch. Now, Harry owns a building in Sydney called the World Tower. It's 75 floors high. He kept the top third for himself as service departments. He invites me up to lunch. I get the lift up there. The butler opens the door. And I'm walking around. He invites me and I see him sitting down. He tells me to come over. And I sit down next to him. But I notice something different in this penthouse. It's a whole floor, but it's got no bedrooms, Michael. It has got 12-foot floor to ceiling height thing. And the views are amazing. It's like owning a whole level of World Tower. Of Centrepoint Tower to yourself.
Yeah.
Anyway, it's pretty amazing. I sit down. I said, Harry, I've written a book. He said, very good. That's how he talks. Very good. I said, oh, it's a book about depreciation and property investment. Very good. I said, Harry, there's a chapter in there about you called High Rise Harry. Michael, he didn't say very good. Anyway, this is before it went to press, and I had a A4 printout of it with a staple in the corner. I said, Harry, I think it's only fair that you read the chapter before it goes to press. And he read it, and there was silence at the table. There's always an entourage with Harry. There was a complete silence for 15 minutes after he read it. Then I hear, very good. And I wipe the sweat off my brow. And when the book gets published, I send him a copy, the first copy off the press. I said, dear Harry, thanks for all the work. You know, it's been great, your loyalty, etc. A week later, his EA rings me up. She says, Tyron, Harry would like 6 more copies, please. I'm like, why? He thinks his executive team should know exactly what you do. Now, here's the 1% kicks in. For the next year, Michael, I get summons to his office for 5 minutes each once a week. And Harry says to me, teach me something new. Teach me something new about depreciation. Now, by week 38, I'm running out of tips and tricks, let me tell you.
I can imagine.
But you think about it, the thirst of knowledge for him is that 1%er. If he does that for all his engineers, all his architects, all his trades, right, it is going off the Richter, his thirst for knowledge. And that, to me, is the ultimate 1%. Now, as property investors, what are some of the 1%ers that we could change? You know, we could make sure we annually review our rental statements or our mortgages. We could review our depreciation schedule, something close to me, and make sure that if we have written anything off or deleted anything, that could change. That could increase our returns. So they're the 1%ers that us as property investors could make, if you ask me.
So the first lesson is be part of the 1% club. That makes sense. What was the second big idea you got from Harry?
Okay, so the KISS principle. We've all heard that saying, keep it simple, stupid,
Yep.
right? I don't know about you, Michael, but in my life, I've created that many different businesses off the one business. I thought I'd go down into the sinking fund businesses or due diligence reports, building insurance reports, strata reports, etc., right? Not Harry. He's just kept it simple. All he's ever done is build apartments and get good at it, right? He could have easily gone down the commercial property route or industrial buildings with his teams of builders and marketers and lawyers, etc. But he's just kept to his apartment. He's kept in his lane. And trust me, it's far easier to build one commercial tower with having one tenant than it is to build 5,000 apartments a year and having 5,000 pesky lawyers and 5,000 pesky defects lists, etc., right? But he's just kept to what he knows best, to keep it simple, stupid.
Good lesson for us all to learn, because we tend to, entrepreneurs in particular, tend to get creative and look for the next shiny toy. Stick to what you're good at. That's a good lesson. What else?
He's also done that in his buildings as well. He's kept them square. You won't see many curved concrete slabs or curved balconies, right? And by keeping them square and upright, you're able to stack the kitchens on top of each other so the services go straight through rather than meandering through the building, which adds cost to the construction as a quantity surveyor, right? And so by keeping his costs down in that way, he's enabled you to get a bigger apartment compared to the competitor down the road by keeping it simple, stupid. And, we can't live in a facade, Michael. We live in an internal area, and we all know size matters.
Yes, even for apartments.
Exactly. All right, the third thing I learned from you, Michael, is systems. If you're 91 years old and you're building 5,000 units a year at 91, you need good systems, right? And I saw this up close recently, the systems that he has in play. He has, at 91, I can tell you now, he still has his finger on the pulse. So you've probably heard of a thing called temporary full expensing, which happened during COVID. It was a COVID government incentive to increase activity by getting us to go and spend money and enabling us to write it off immediately rather than depreciating it over a period of time. Now, that for you or me, that might be something like we could have bought a car and depreciate it. But if you're Harry Triguboff and you're building 5,000 units a year, you might keep half as service apartments or keep blocks by themselves. It's a big deal. So to give an example to the audience, if he was to build a hotel and he's spending $3 million on the lifts, normally you'd have to wait till the hotel is completed and then depreciate that lift over a 30-year period at $100,000 per annum. But if you're halfway of that construction, as at 30th of June, you could claim $1.5 million as an outright deduction rather than over 30 years. So it's a big deal. So he engaged me to go out to all these building sites and work out what the ratio of construction completion is on each building. Now, that's a big job.
Yeah.
One building site has 44 blocks in it. Not apartments, 44 blocks. And as you know, you don't build them all at one time. You stage the developments. You move your construction team from one end to the other. You sell one block, you move them on to the next. So I get out there and there's like 10 different building blocks at different stages. And I'm like, where do I start, Michael? So I've got my notepad and I get the foreman and I say, okay, how many ovens are completed in block C? And he'll be like 192 out of 238. I said, okay, that's impressive. What about block D? 54 out of 132, et cetera, et cetera. And it kept going on. He knew every stat of every building. And then I go around every other site, and every developer, every project manager or foreman knew exactly the same stats. I'm like, what's going on here? I said, why is all this? Well, they have to report to Harry every week the exact completion of every item in every building, right? So he knew exactly where every building is each week because he knows if in Block C on Pagewood site there's 192 ovens this day, by the next week there should be 232 or there's a problem. Because speed of construction is one of the easiest ways to work out if there's a problem of the job, right? And with Harry, it's not cash flow. So there has to be something else. So his systems are to make sure he knows exactly where the jobs are in order to know whether there is a problem on that job. So he's got good systems.
Fantastic. So he keeps it simple, but he keeps track of it all with systems.
Yes. And I think from a property investor's point of view, they could have a system in when they're determining what to buy. They could have a system saying, I want to buy a 4% yield property. So to break this down to not everyone's building 44 blocks of apartments.
You're calling it a system. I'd call it a strategy because most actually get involved emotionally, and that's the wrong way. So you really should know what you're doing. I agree with you, Tyron.
Mm-hmm. Yeah, so things like, I guess you could have, your goals of being within this is your bread and butter, rather than mine, but having, a 5K within a 5K city or a 1 minute, 10-minute walk to train station, etc. So there's some systems or strategies, as you say, that investors could have for sure.
Definitely. What else have you learned from the $1 billion man?
Well, I'm going to end on a really good one, but we're going to get there. But I'm going to tell you the secret to his success. So hopefully,
Oh,
people will
that's
stick around.
worth listening to, worth hanging on to. Hey, that's a good teaser, Tyron. I like that one.
Yeah. Yeah, so great. Number 4 is the loyalty. Look, you can't build that many apartments without having loyalty to trades, etc. Like I've been with him for 27 years. There is a saying: if you last a week with Harry, you last 20 years, right? Because and now there's multi-generational trades people that have worked with him, people that he worked with his grandfathers that started. Now there's the grandkids within those trades, and most of the competitors have approached him over those 27 years for me, and he just sent me some of their proposals. Said, "What do you think, Tyron?" Now, if you think that doesn't deserve reward loyalty from me, it sure does, right?
Yes.
So loyalty is something, and I've had that. The average tenure of a Washington Brown employee is 14.2 years. I can't get rid of them, Michael, but they certainly enable loyalty with me as well. So.
Well, obviously, some of these good habits have trickled down, stuck to you, and that's why you're successful. Well done.
Thank you, Michael. Number 5 thing I've learned from him is follow the leader. Now, I've made a fair bit of money out of Harry over the years, but I would have made more money if I followed him or the people like Tim Gurner or Lang Walker. When they go into develop an area, they change the area, Michael. And when Harry went and started developing in certain areas like Alexandria, if I went and bought in townhouses around the corner, etc., I would have made more money than just on the fees. Followed the leader, not follow the crowd, follow the leader. Now, investors can do that now. You can find out where things like Bunnings are being built and follow. They have teams of demographers working out where the next growth corridor are. So investors can find out those things. So following the leader wouldn't be such a bad strategy. You have to follow the good leaders, though, the smart people that are developing, not just the people you read on Facebook forums.
Definitely, because sometimes pioneers get arrows in their back, so you've got to be careful who you follow. Sure.
Yeah.
Okay.
Number 6, cash is king. Now, we've all heard that saying, Michael, but when you see it in real life and with big money, it is quite amazing some of the deals that I've seen him do. I'm not going to talk about name those sites, but I'll tell you one story. And this happened in the GFC. He bought a site once that was, say you had an A4 piece of paper. Go to the right-hand corner, and he bought it, say, for $20 million. Go to the right-hand corner, top corner, and cut 1 centimetre square out of that top corner. The next day, he sold that corner commercial building for $20 million. He got the whole site for in essence, nothing. He then got approval for 2,500 apartments on that site, right? Now, in today's Oz, that's probably worth about $500 million. So he made $500 million risk-free overnight virtually. Now, how did he do that? Because now we don't all have $20 million, but what we do all have we can have is patience, because he sits back and waits, right? And when something like GFC comes along, there's always a fund that's going to be overgeared that needs a quick decision, right? They know that with Macquarie Bank, they'd have to go to some subcommittee to buy that site. With Harry, he can just write a check, and they know it's not going to bounce, right? And the liquidators want to get paid, etc. So some fund will always overgear, try and promise extra returns. And with Harry, patience can benefit the investors. We don't always have to be fully invested, Michael, from my experience. Sometimes doing nothing, if you ask me, is the best investment strategy you can make.
Well, Warren Buffett wisely said wealth is the transfer of money from the impatient to the patient.
Absolutely. Which is a good lead-in to the secret.
The secret.
The secret to Harry's success, as told by him to me. Now, before I tell this story, I want to let you know, when Harry talks, he often ends his sentences with a higher intonation on the final word, okay? So Harry says to me, "Tyron, do you want to know the secret to my success?" Now, Michael, I'm not going to say no. Yeah. Yes, Harry, what's the secret to your success? Listen to me, he said, "When times are bad, I buy land. By the time I get development approval, times are good again." I'll say that again. When times are bad, I buy land. By the time I get development approval, 2 to 3 years later, times are good again. You see, what does that mean? That means good times will follow bad times will follow good times. It means yin when others are yanging, right? It means back yourself and, cut out the noise of the media and just back yourself, Michael. You see, for someone like Harry that buys a land, develops it, and then keeps half his stock, right? It's not a question of whether you time the market or have time in the market. You see, for Harry, he times the market and then has time in the market. And if you ask me, if you can do that, you found the holy grail.
That's a great combination, isn't it? So while most developers just buy properties, develop and sell, I know a little bit about his strategy that he, as you say, he keeps some, and he's got service departments and he's got hotels. So a number of cash flow streams as well. That goes back to cash is king also. Cash flow keeps you in the game, but also he owns the assets. So capital growth has kept building his asset base, hasn't it?
I've seen so many developers over my years, because Washington Brown was originally a typical quantity surveying where we did bank auditing. So we would work with developers as the bank project auditor. And so many developers, I look back on time and go, if they just kept half their stock and borrowed and accessed that equity, then did it in its development rather than continually trying to recycle it, they would have been better off with the way that the markets in Sydney and Melbourne have actually performed over time.
Definitely. Sure, but that's not as exciting.
No.
How often have I heard builders and developers say the same? If only I'd kept that one. Because over the last couple of years, most builders, many developers have had cash flow troubles with the cost of contracts, meaning that many of the jobs they're doing are not being financially viable in the rising cost environment. Sure, I think there's some great lessons there. Be part of the 1% club. Keep it simple. Have systems in place to make sure that you keep your finger on the pulse. Breed loyalty with your team. Follow the leader. Cash is king. And the secret is, I guess, that the property market moves in cycles. So don't mess up the power of compounding. Just play the game. I think he's also got confidence in the fundamentals of Australia. He's got a long-term view, hasn't he?
Yes, he has. And look, for someone who's 91, he's still buying sites that are going to go for another 10 years. So he's certainly got confidence, and that's the definition of optimism.
Isn't it? Well, we've learned some great things from you. If people want to know a little bit more about you, I'll leave a link to Washington Brown in the show notes. But how do you help investors? What can you do for them?
Well, we save property investors money, basically, Michael. So when they buy an investment property, whether it be, that's what we do a lot with Harry. That's mainly what we do now. So when people buy an investment property, whether it be commercial, residential, we work out what the original construction cost is, and we give them a depreciation schedule that reduces their taxable income.
Good. Sounds good. No one wants to pay more tax than they need to. Thank you very much for giving us some insights into all those years working with Harry. And let's hope he's around for many more years and we can have another chat in the near future. Thanks for your time, Tyron.
Thank you so much, Michael. I really appreciate it.
Well, there were some interesting thoughts there from Tyron Hyde regarding Harry Triguboff's secrets to success. I'm sure there's a lot more than just that, but one of the secrets has been just to keep holding real estate in the long term, buying the right properties, adding value, and as he said, keeping it simple. Now, by the way, before we get on to the next segment of this show, if you don't currently subscribe to this podcast, just stop for a second on whatever podcast player you're listening to this, or if you're watching this on YouTube, as a lot of people do as well, or it's an audio only on YouTube, just subscribe so twice a week you're going to keep up to date with the thoughts of my guests and myself. But just talking about real estate as a wealth creator like Harry Triguboff, investment grade property is a pretty hard asset class to beat. The challenge, of course, is locating an investment-grade property. That's becoming more elusive than finding your missing car keys, and it's only going to get worse. Of course, this also creates an outstanding real estate window. In most asset classes, the future's largely unknown, like in stocks, the futures market, derivative bonds, crypto. Now, sure, property's got some unknowns, but I see 5 certainties for our housing markets moving forward. I think inflation's going to stick around a lot longer than the Reserve Bank would like. I believe interest rates are eventually going to fall, but they're going to remain a little bit higher than many of us would hope for a while. I believe the scarcity of dwellings, both for purchase and rent, is not going to go away anytime soon. We've spoken about that so often on this podcast. That means that rents are going to keep rising, as are property values. And I believe over the medium to long term, Australia's got astoundingly good demographics and strong population growth that's going to keep fueling the demand for housing. Look, that's all inevitable. Many try and predict the future but fail, but these 5 profitable real estate tailwinds for investors are assured. And so, therefore, if the timing is right for you, Don't wait for interest rates to fall. Don't wait for everybody to know, hey, now the market's moving forward, because it is still moving forward, but not as strongly as it did earlier this year or end of last year. But the market is moving forward. But by the time everyone else hops in the market, you're going to be competing with a whole lot of others who suddenly have got increased borrowing capacity because interest rates are falling or because tax cuts are coming in. So my suggestion is have a chat with the team at Metropole, one of our wealth strategists, to help build your property portfolio. We're much more than just another buyer's agent. We help our clients safely build intergenerational wealth through strategic property and wealth advice. And we're big enough to tip the scales in your favour, but still small enough to care. So go to metropole.com.au and organise a free chat with one of our wealth strategists to discuss your property options.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I want to explain to you why you shouldn't worry about your failures. Look, we all get things wrong. We all make mistakes. But I want to explain to you a couple of reasons why failing is overrated. Now, I've failed in all sorts of ways in my life, in my personal life, in my business life, even in my investments over the years. But let me again remind you why failing is overrated. First of all, failure is never permanent. That sinking feeling that you've got, that'll never last forever. The best way to reflect on your failures is to focus on the lessons that you've learned and the persons you're going to become, rather than spending your time trying to avoid failure. The less time you spend on rejection, the faster you're going to grow. The second way you should think about failure differently is to own up to your failures. The moment you openly talk about the things that make you vulnerable, they no longer have power over you. People will appreciate your honesty because everyone knows what it's like when they've had setbacks, when they've made mistakes. They're going to respect you for owning up to your problems and embracing your failures. And in the process, you will become stronger. Now, another reason why failing is overrated is the world won't change unless you do. The world owes you nothing. It was here first. We can't blame the shortfalls in our lives or other people around us or past decisions that we've made for how things are in the present. It's not the events that define who you are. It's how you choose to react to them. So forget what others are saying. They're never going to judge you anyway. They don't really care as much about what you're doing or how you performed like you think. But you do have to realise that if you want the world to change, you're going to have to change your ways first. Now, this is a common theme that comes through my mindset moments, isn't it? So the next question really is, how badly do you want it? Whatever it is that hasn't worked out. As Steve Jobs once said, if you don't love it, you're going to fail. Look, we've all heard about Thomas Edison, who had 1,000, or supposedly 1,000 unsuccessful attempts at inventing the light bulb. But from his perspective, I didn't fail 1,000 times. He's said to have said that the light bulb was just an invention that took 1,000 steps to get there. So I'd like you to remember that just because you failed, it doesn't mean you're a failure. Never let failure deteriorate your self-worth. Now, I know it's easy to say and it's hard to think about it that way, but if your head hurts, you say, I've got a headache. You don't say, I am a headache. So failure is nothing more than an event. It doesn't mean you're a failure, so don't personalise it. And it's really important to recognise that failure is part of the process. The fastest way to success is to double your failure rate. Successful people have failed more times than a beginner has ever tried. If you want to succeed, fail faster. I often say I'm a real success at failure, but that's okay because I get up one more time, and so should you. So don't worry about your failures. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast, go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports, my way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?